Your thumb is over the sell button, and the coffee's gone cold. That low hum you're feeling isn't weakness. It's the sense that standing still is itself a kind of negligence. So here are 8 questions to run before the order goes in, each one answerable in under a minute. The first can genuinely tell you to sell. That's the point. A checklist that can only ever say hold isn't a checklist. It's a slogan. Nothing on that screen tells you whether selling is right this morning. Not the red, not the size of the red. All it tells you is that something moved. The work of the next few minutes is separating a decision from a reaction, right now while your thumb is still where it is, and not afterward when you can narrate it into sense. 8 questions, in order. By the end, you'll have them portable enough to keep in a drawer, and you'll know which one usually does the deciding. Question 1. The story and the price. Has the thesis changed, or has only the price changed? Before that gets comfortable, let me put the strongest case against patience on the table with real numbers and not soften it. The Nikkei 225 closed at 38,915.87 on the 29th of December, 1989. It did not close above that level again until the 22nd of February, 2024. 34 years for a diversified index of the largest companies in a wealthy, functioning nation.
Anyone who tells you holding always works has to explain that chart. The Nasdaq Composite peaked at 5,048.62 on the 10th of March 2000 and didn't close above it until the 23rd of April 2015, about 15 years. And American stocks had their first negative calendar decade on record. The S&P 500's total return for 2000 through 2009 was roughly -9% cumulative, a little under -1% a year, dividends included. At the level of individual companies, the losses weren't delays, they were endings. Citigroup's pre-crisis peak, adjusted for its 1-4-10 reverse split in 2011, sits somewhere around $570 a share. Shareholders who bought at the top have waited nearly 20 years and are nowhere near whole. General Electric peaked near $60 in August of 2000, which after its 1-for-8 reverse split in 2021 is the equivalent of roughly $480, more than a quarter of a century, still short. I give you those because each of them has a specific answer rather than a reassurance. Against the risk of a single company owning the index instead of the story, an index quietly replaces its failures, and a single share certificate cannot. Against the risk of a single country spreading globally. Over that same stretch from 2000 to 2009, while the S&P 500 lost money, emerging market equities returned something like 10% a year, and a globally spread portfolio didn't have a lost decade at all. A company can be a mistake. A country can be a mistake. A concentration can be a mistake. What history has not yet punished is a globally diversified owner with time. So the question you're actually answering is narrow. Has something changed about what this asset is, or only about what someone will pay for it this morning? Write one sentence naming what changed that isn't the price. A real change in the business. A change in your own life. A concentration that has grown while you weren't looking. If you can't fill in that sentence, you haven't found a reason, you've found a quote. There is one exception to all of it. Money that was never supposed to be brave in the first place. Question 2. The money with a date on it. Do I need this specific money in the next 5 years? Picture a couple in their mid-30s with 2 accounts. In one is the deposit for a flat they hope to buy in about 18 months. In the other is retirement money they won't touch for 30 years. On a red morning, both accounts fall by the same percentage, and both produce exactly the same feeling in the chest. Only one of them is a real problem, and it isn't the big one.
The whole question rests on how long recoveries have taken, so here are the durations rather than a while. 2020 was fast in both directions. The S&P 500 fell 33.9% from its high on the 19th of February to its low on the 23rd of March, 33 days, and set a new high on the 18th of August, under 6 months later. 2022 was slower. Peak on the 3rd of January, trough on the 12th of October, about 25% lower. New high on the 19th of January 2024, roughly 2 years. The financial crisis was slower still, a peak on the 9th of October 2007, a fall of 57% to the 9th of March 2009, and no close above that old high until the 28th of March 2013, about 5.5 years on price alone, though reinvested dividends shortened the real round trip by roughly a year. And 1929 is the outer edge. The Dow's peak of 381.17 on the 3rd of September 1929 wasn't seen again until the 23rd of November 1954, 25 years in nominal price terms, although because dividends were large and prices themselves fell through the 1930s, a reinvesting investor was made whole considerably sooner than that number suggests. Set against those, the base rates.
In data reaching back to 1926, American stocks have been positive in roughly 3 of every 4 calendar years, in about 94% of 10-year periods, and there has not yet been a negative 20-year total return, though honesty requires adding that in inflation-adjusted terms, the 20 years ending in the early 1980s were close to flat. None of that is a forecast. It's a shape. 5 years isn't magic. The point is that a decline only becomes a loss when it collides with a deadline. Give every pot of money a date before the next bad morning, not during it, which leaves the harder case. The money has no date. The thesis hasn't changed, and you still want to sell. Question 3. The feeling under the order. Am I selling to change my portfolio or to stop a feeling? Selling is remarkably good at ending discomfort. The relief arrives within seconds, and it is completely unrelated to whether the decision was sound. That is exactly why it's such an unreliable signal. In 2005, in the journal Psychological Science, Baba Shiv, George Lowenstein, Antoine Bechara, and Antonio and Hannah Damasio ran a simple investment game. 20 rounds, $1 at stake each round, a coin flip that paid $2.50 for heads and cost the dollar for tails. Every single round was worth taking.
Participants with damage to the emotion processing regions of the brain invested in about 84% of rounds. The neurologically typical participants invested in about 58%, because after a couple of losses, the losses began to hurt and they stopped. The group that couldn't feel the sting finished with more money. That isn't a case that emotion is a defect. The study's own authors were careful about that. It's that feeling is already doing work in the decision, work you'll later file under analysis. Kahneman and Tversky's prospect theory research put a rough size on the asymmetry. A loss registers something like 2 to 2.5 times as strongly as an equivalent gain. And you're less alone in your hesitation than the morning suggests. Vanguard reported that during the crash from February to May of 2020, roughly half of 1% of its self-directed households moved entirely out of equities. Half of 1%. The stampede you can hear is loud, not large. So name the feeling out loud before you name the trade. This is fear. This is boredom. This is embarrassment about telling my partner. Then impose a delay. A day, a night's sleep, a walk to the end of the road. A decision that's still right tomorrow loses almost nothing by waiting. A decision that evaporates overnight was never a decision. Say it survives the night.
There's still a second half that almost nobody plans. Question 4. The door you have to find again. What would I have to be right about twice? A migrating bird is never judged on its departure. Leaving is the easy half. The sky empties, the instinct is shared, the whole flock goes at once. Survival is decided by the return. Arriving back not so early that a late frost catches it, not so late that the nesting sites are gone. Nobody photographs the landing. JP Morgan Asset Management's widely circulated analysis of the 20 years ending December 2022 found that $10,000 left in the S&P 500 for the whole period grew to about $64,844, roughly 9.8% a year. The same $10,000 that missed only the 10 single best days finished near $29,708, about 5.6% a year. 10 days out of roughly 5,000 trading days. Bank of America ran a longer version, 1930 to 2020. Holding through everything produced a cumulative return in the region of 17,700%, while missing just the 10 best days of each decade produced about 28%. Now the part that usually gets left off, and without it the rest is just advertising. Run the identical arithmetic in reverse, and missing the 10 worst days would have helped just as dramatically. What the numbers actually show is that the best days and the worst days sit beside each other. JP.
Morgan's own note observes that 7 of the 10 best days in that period fell within 2 weeks of the 10 worst. They arrive in the same weather. Nobody has demonstrated a reliable way to take one and leave the other, and the exit you're contemplating is a wager that you can, which is why the return matters more than the departure. Before you sell, write down the condition that will bring you back. A level, a date, a piece of news, something specific enough that you could hand it to a stranger and they'd know when to act.
If you can't write the re-entry rule, you aren't making a plan with two halves. You're making one decision and trusting that the other will feel obvious later, at the precise moment when nothing feels obvious. And if you're still inclined to go, the leaving itself carries a price. Question 5. The toll on the way out. What does this actually cost me? In tax and in the price of getting back in. The sell button is free. The transaction is not. Let me do the arithmetic out loud, and let me say plainly that it's illustrative. A made-up example to show the shape, not anyone's actual tax outcome. Imagine a holding in a taxable account worth $100,000, of which $40,000 is gain, held more than a year. At a 15% United States federal long-term capital gains rate, the tax on selling comes to around $6,000. That's before any state tax and before the additional 3.8% net investment income tax that applies to higher earners, which means you'd have to buy that position back roughly 6% cheaper than where you sold it just to stand exactly where you're standing now. And that's before you've even made the re-entry decision from question 4. 3 structural details worth carrying because they're checkable and they turn on things nobody is thinking about at 7 in the morning. In the United States, gains on assets held a year or less are taxed as ordinary income at rates reaching 37% federally, while long-term gains sit at 0, 15, or 20, a difference that can hinge on a single calendar date. If you're selling at a loss and intending to buy back, the wash sale rule disallows that loss if you repurchase a substantially identical security within 30 days either side of the sale. And the quietest one of all, an unrealized gain is a tax bill you have chosen to postpone indefinitely at no interest. Selling is volunteering to pay it early. Rules differ by country and change over time, and none of this is individual tax advice. A tax-sheltered retirement account changes the entire calculation, which is itself worth knowing before you touch anything. So calculate the exit before you feel the exit.
Open the cost basis page, find the rate, write the number down. A decision that made emotional sense at zero cost often reads differently once it carries a visible price. And if the number doesn't change your mind, you'll at least have chosen it with your eyes open. Suppose it survives even that. One more question remains, and it removes the single number the market has never heard of. Question 6. The test of empty hands. If I held none of this today and had the cash instead, would I buy it at this price? In 1990, Daniel Kahneman, Jack Netsch, and Richard Thaler ran the experiments that became known as the Cornell Mug Studies. Students given an ordinary coffee mug and asked what they'd sell it for named prices roughly 2 to 3 times what students without a mug would pay for the same object. In one reported round, a median asking price near $7.12 against a median offer near $2.87. Minutes of ownership were enough to change what a mug appeared to be worth. Years of ownership, plus a purchase price you remember to the cent, do rather more than minutes. Samuelson and Zeckhauser named the neighboring finding in 1988, status quo bias, our documented habit of treating whatever we already hold as the neutral, correct option. Terence O'Dean's 1998 study of thousands of brokerage accounts found the exact pattern this question is built to interrupt.
Investors sold their winners far more readily than their losers, and the winners they sold went on to outperform the losers they kept by about 3.4 percentage points over the following year. They held what hurt and cashed in what worked. There's also a third answer, more useful than yes or no. Sometimes the honest response to "would I buy this today" is "not this much of it." That's not an instruction to sell everything. It's information about position size, and it usually points toward a trim or simply directing future contributions somewhere else, rather than an exit. Ask it in the empty hands form every time, because it makes you evaluate the asset instead of defending the purchase. Your cost basis is a fact about your past. It is not a fact about the investment, and it gets no vote. There's one more voice in the room this morning, though, and it isn't yours. Question 7. Whose hurry is this? Who, other than me, benefits if I place this order? Not a conspiracy. Nobody is doing anything wrong. It's simply the structure of the thing, and it's worth seeing clearly while your thumb is hovering. Brad Barber and Terence O'Dean's 2000 study, Trading is Hazardous to Your Wealth, examined 66,465 American households at a large discount broker between 1991 and 1996. The market returned 17.9% a year over that stretch. The average household earned 16.4% net. The most active fifth of households, the ones doing the most deciding, earned 11.4%. Most of that gap came less from bad judgment about which companies to own than from the sheer cost of acting.
In the same body of work, the stocks these investors bought went on to underperform the ones they sold by around 3.2 percentage points over the following year. They traded their way backwards, one reasonable-seeming decision at a time. Barber, Lee, Liu, and Odin scaled it up in Taiwan, where they had the rare advantage of a complete national trading record. Individual investors' aggregate trading losses ran to roughly 2.2% of Taiwan's entire economic output. Among day traders specifically, well under 1% achieved reliably profitable results. And it didn't disappear when commissions did. Morningstar's Mind the Gap study measures the difference between what funds returned and what their investors actually earned, once you account for the timing of their own buying and selling. For the 10 years ending December 2023, investors captured roughly 6.3% a year against the fund's 7.3%, about a percentage point every year, surrendered entirely to the getting in and out. Commission-free is not cost-free.
There's a spread on every trade. Order flow is a product that gets sold, and the app in your hand is engineered, the notifications, the colors, the little haptic tap, to make acting feel like responsibility. Nothing in that interface rewards a decade of stillness, because stillness generates nothing for anybody but you. If the honest answer to question 7 is the platform, the spread, and my own nervous system, that isn't proof the trade is wrong. It's a reason to finish the list. Which brings us to the last question, the only one that isn't really answered by the you standing at this counter. Question 8, the letter you already wrote. What did I write down when I bought this? The most reliable authority on whether to sell is the calmer person who made the purchase. But that person only gets a vote if they left a record, because memory will not preserve them faithfully. In 1975, Baruch Fischoff and Ruth Bath asked people to assign probabilities to the possible outcomes of Nixon's diplomatic trips to China and the Soviet Union, and then afterward asked them to recall the probabilities they'd given. People systematically remembered having been more confident about what actually happened than they had been.
Philip Tetlock found the same thing at professional scale in his long-running forecasting work. Experts asked to recall their own past predictions remembered them as considerably more accurate than the written record showed. Applied to a red morning, that failure is specific and nearly invisible. You bought a broad index fund for a 30-year horizon, and you expected several serious declines along the way. 6 years later, in a bad week, you remember buying it because things were going well, and so things going badly now feels like proof the thesis has failed, when the thesis anticipated precisely this. The repair is a single page, written on the day you buy, in plain language. What this money is for, when I expect to need it, what I expect to feel in a decline of 30 or 40%. What would genuinely constitute a reason to sell, and what specifically would not. Professionals call it an investment policy statement, which makes it sound institutional. It's closer to a letter left for a version of yourself you haven't met yet, someone who will be frightened and short of time. Odysseus didn't resist the sirens by being strong in the moment. He arranged the ropes in advance, on a calm morning, while he could still think. If you have that page, read it before you sell. That is the whole of question 8.
If you don't have it, you've just found the most valuable thing this list can give you, and you can write it today while nothing is falling. The best morning to decide how you behave in a storm is a morning with no weather in it at all. So, back to the counter. The coffee, the red number, the thumb. Nothing there has changed except you. You have 8 questions now. Has the thesis changed or only the price? Do I need this specific money within 5 years? Am I selling to change the portfolio or to stop a feeling? What would I have to be right about twice? What does the exit cost me in tax and in getting back in? Would I buy this today with empty hands? Who else benefits from my hurry? And what did I write down when I bought it? They are not a machine for producing the answer hold. I told you at the start that the first one can genuinely tell you to sell, and it can. A concentration that has quietly grown too large, a company whose story has actually ended, money that turns out to have a date on it after all. That's what makes the list worth carrying. It was never meant to make you passive. It was meant to make sure that when you act, it's you acting and not the morning. And that hum you felt at the beginning, the one insisting that standing still was a kind of negligence, notice what it actually was. Not information, just speed.
You won't always get this right, and you don't have to. You only have to be the kind of investor who asks before acting, more often than not, for a very long time. That's a lower bar than the internet suggests, and it's the one that quietly decides how all of this goes. Keep the 8 somewhere you'll find them in a hurry. The Notes app, the kind of morning you're having. And if one of the 8 landed harder than the others, leave a comment telling me which one. The question that stings is usually the one you needed. Until next time, take your time.